It's time now for the Gem Young Wealthcast. Brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprilli.
Welcome to the Gem Young Wealthcast. This is Leo Daprilli. Excuse me. Thank you for joining us today. This is our first in our series of analyst reviews for the month of July. I have with me Elizabeth McConville. She's the Senior Regional Investment Specialist at AssetMark, and Elizabeth has become quite the accomplished public speaker along the way. She's a very bright individual. She has a lot to offer, and I'm really glad to have her on the program today. So, hey, Elizabeth.
Hi, Leo. Great to be back on the show. Thank you so much.
Yeah, thanks for jumping in. You know, over the past several months, I've got to hear you speak a couple of times, and I'm really excited to have our listeners hear your point of view on things. You have a very intelligent perspective, a well-researched perspective, and with everything that's been going on in the world this last quarter, I thought there'd be a lot that we could dive into. So let me start by asking you surprises for the quarter. What surprised you for this quarter?
Yeah. I think another thing that just continues to surprise me is despite a lot of the geopolitical headlines, tariff headlines dominated last year, just how resilient the markets continue to be. You know, we've had a little bit of slowing growth, and we can talk about that. Higher inflation, that combination really is not conducive for equity markets, for bond markets, but yet here we are, the S&P 500 up 9-10%. International firing, emerging markets really having its moment. So there's tailwinds, there's headwinds, but I think the big surprise to me is just how resilient, even if the economy is slowing in some areas, and we'll get into all of that, just the resilience always continues to surprise me of markets.
And you know, Elizabeth, for a long time, I'm glad you brought up emerging markets. They've kind of become, you know, they used to become the ugly stepchild of the portfolio for so long. And those of us in the diversification camp said, just be patient with it, because I've been around long enough to know that one asset class typically doesn't win year after year, even though large caps defied that to a degree. 26 is proving to be the year where diversification is really giving portfolios the horsepower.
Yeah, that's absolutely right. And we're asset allocators. We also build portfolios for diversification, right? There are risks and headwinds that we know about, but to your point, there are surprises, and every year brings a little bit of a different market dynamic. So where the U.S. markets have done quite well this year, and as we know very well over the last 3 years, international continues to outperform the U.S., a little neck and neck, but still a little bit of outperformance. But emerging markets really having its moment. Last year also accelerated by a falling dollar. But this year, with that artificial intelligence spend and build out, emerging markets really driven by Asian technology companies and semiconductor companies, this global infrastructure build out, really sort of driving emerging markets higher. So to your point, everything in moderation in a portfolio. We build portfolios for diversification, so we don't need to go all in and pile into emerging market equity. It can be a volatile asset class. There's different dynamics that make it work well, and other years not work so well. But this year, more tailwinds, and we're seeing that expressed in our portfolios in moderation.
So what has been the biggest win that you've seen in the quarter?
Right. So I think diversification is certainly working. I think when we're thinking about what's winning in the quarter, I think, AI, technology, semiconductors in particular, really having their moment. But again, diversification is key, because what we're seeing, U.S. growth being relatively stable, the drivers of that growth shifting. So, the U.S. consumer makes up the majority of GDP, but what's contributing to GDP in terms of, the consumer pulling back a little bit, government spending and business spending sort of ticking up. And so we still have a little bit softer GDP growth in Q1 so far. about 1.6% for the quarter. When we look back over the last 5 years, GDP has been about 2.2% on average. So not bad, but definitely cautious, but within that sort of working, to your point. So within tech, and we have a lot of tech in our market indices here in the US, and US tech has done really well. Some of the winners that we've seen, expressed more in the semiconductor area, maybe not so much in the software area. Um, you know, within some of the portfolios that we run, we can find great opportunities. Like even in the healthcare sector has been relatively flat for the year, but we've found really great names in healthcare that have contributed meaningfully to some of our portfolios. So I would say broadly speaking, with this AI build and it kind of moving, to different areas that are affecting the broader economy, which is exciting to see more names besides the Magnificent Seven participate in materials, in industrials, as we sort of move to different parts of the AI build out, not just selling GPUs, not just in the cloud, but energy build out, infrastructure build out. So we're seeing more like onshore manufacturing work quite well as we think about moving to just industrials, materials, manufacturing, and that sort of thing. So certainly helps to be diversified, but we're looking for those particular areas of opportunity and expressing those in our portfolios.
So with the AI build that's going on, and it's, as you said, there's a lot of huge winners to this point. But I think the story that's yet to be written is where AI really starts to permeate into businesses. And we're not there yet because I think it's AI still probably more to do data research than it is to actually to make companies more efficient. But I think that's coming. And I said this, Elizabeth, Stephen, and I were when we did our analyst report back in October. I said the biggest risk to AI, and what I saw then was the massive spend for data centers and the great reluctance then for cities and states to want to have more data centers. And that seems to be, that's gotten very hot. So I kind of saw that coming. It was pretty easy to see coming that even though there's going to be a lot of winners and losers in the AI space, which goes to your point of being judicious and having moderation to what's in the portfolios, because not every one of them is going to win, kind of feels a little bit like 1999 and 2000 to me, when every company coming out was going to solve the world's problems. But then there becomes the issue of capital, the issue of acceptance of their product, their ability to monetize what their products are. So I think we're still kind of in that stage too, and the bigger players are different this time in what they've invested in and how they're going about it. And they have the capital to continue to pivot as this continues to evolve. But it's profoundly changing business and industry along the way. And like, for instance, you brought up healthcare. This is the beauty of privately managed portfolios. If you're more of an index-driven portfolio, and you don't really have control necessarily over what's in the portfolio, you could be having a lot of sectors that just lay flat, but your prospectus mandates that. Whereas you can pivot and say, look, we're finding some shining stars in here. And then if you look at AI, and where I think that could go in medicine, because if you look at, just go to a hospital, go to a doctor's office and see how capital intensive it is to do anything, right? So I'm sure the leadership in the healthcare industry is looking at something like that by saying, okay, this is an opportunity maybe where we can streamline a lot of things that we do, right? So I bring it up in that context to give you the runway to say, here's how deep the research goes for what you folks do and the information you're providing your team, right, in terms of selections of what may or may not go in a portfolio.
Absolutely. And I think to your point, just the spend on AI is really spreading across the economy. And there are, a lot of viewpoints on this. But the fact, if we just look at the dollars, those AI investment estimates going forward, even in the spend, the last few years has been huge. The numbers are like mind-boggling, just how much CapEx spending, whether it's on compute, whether it's on data center, whether it's on power and energy. It's really like the numbers are so large, it's mind-boggling. But the spend estimates continue to look higher and higher going forward through 2026, 2027, 2028, and beyond. But there are, to your point, more AI adoption sectors. When we look sort of like across the sectors, across all industries of our economy, more and more sectors are beginning to adopt AI and find really interesting ways to implement artificial intelligence. And some, like the hyperscalers, are driving all of this. Many companies out there are figuring it out, but as this moves forward, a lot more companies are finding more interesting ways to use it. And what this really brings, to your point, is, innovation drives disruption. But markets do adapt to that. So to your point, like, is it 1999? Is it 2001? Is it 2002 or 2003? Like, where are we? Are we in a bubble? Is this thing about to cause mass disruption across our economies? I think one thing to keep in mind is, while so many things about AI are obviously very, very unique, and the complete direction and the complete picture is, the story is still, there's many open questions, we would say. But the idea of technology waves reshaping industries is not new. And to your point, I think you mentioned, like, is this like the PC era of the 1980s, or are we in the internet era of the 1990s? When we look back over these past decades, the broader S&P 500, 44% of companies across all sectors in the S&P over the decades have actually experienced some type of catastrophic loss, where maybe 70% or more of these companies had declines that they never recovered from. That value was not recovered. And when we think about tech specifically, 59% of companies in information technology experienced catastrophic loss. So lost 70% or greater that wasn't recovered. But with that, markets take shape and new large companies emerge. When we look at sort of the top 10 companies in something like the S&P over the last decades, each decade, different company names emerge. Like in 1980s, the PC era, like I think of names like Kodak that don't exist anymore.
Compact
So
computer.
Absolutely.
Right?
Absolutely. Some of this disruption is normal. And markets really look, for earnings, and earnings drives that higher. And so this is really just kind of part of the cycle. And so a lot, to your point, is an open question, but that's how we're thinking about that. And we think about it in the way Savos picks stocks, through value, through quality, through momentum. So not just being invested and buying the entire basket, but through active management, identifying through factor screenings the winners and losers to make appropriate active weight so that our portfolios can continue to help clients meet their long-term goals. And that's what it's really about, right? It's about not these short-term headlines and disruptions, but that longer-term investment trend.
That's great stuff. And here's why that's important and why I wanted to bring it up, because everybody talks about AI all the time, but in terms of the implications of what that really means, and it's a great point you brought up, Elizabeth, about how many of these companies 10 years ago, 20 years ago, just don't exist anymore, and the catastrophic failures they go through. And nobody ever sees those coming, right? You guys might, because you're analyzing it, and we talk in our business, we use the word moat a lot, right? How big's your moat, right? How small is your moat? And the smaller the moat, the more vulnerable the company is, right? And those are things that factor in your decision, especially when you say you're looking for growing companies that create value, and if you're running on a thin moat, you really can't do that, and you can't really afford to stub your toe. So companies like that have a great deal of risk, and those are the companies in time that, like you said, they're not here anymore because of that. But I think the average consumer, the way they behave is when they buy things, whether it's groceries, a car, a house, or stocks, they emotionally invest in them, right? And they the flaw that I've seen through my career is they tend to hold too long because they've emotionally connected with it. But good money management and professional money managers don't do that, right? They stick to the data, and the company needs to continue to perform the way you're expecting them to perform for them to remain within your portfolio. And that's a whole nother level of discipline. And it's having an investment committee like you folks do, where you roundtable these conversations. So you're getting different professional points of view. So it's a pretty arduous process. And it's funny, it's a side note, but you know me well enough. I'm going to go left and right all the time, right?
Absolutely.
So I just, for the heck of it, I used AI to do some due diligence on maybe some stocks. And I just wanted to see what would happen with it, right? Because I know how we do it. I know how you guys do it, right? And I went and said, really not any better than what we got, right? Maybe it organized it a little bit differently, and it gave me the factual context to an analysis. But in terms of going deeper, like you go deeper into it, it didn't do it. It didn't get there. So if people are thinking they can just use AI to come up with stock recommendations and build portfolios, I'll be honest with you, I just really wasn't a fan of it. And I'm an AI advocate. Let me say that.
Absolutely, absolutely. And we see, and I'm sure you see this side of it as well, not just sort of what we refer to as the retail investor or the do-it-yourself investor. And we have some, because markets have been on this bull run, we've seen double-digit equity market returns over the last few years. So there are some people out there, do-it-yourself investors, that have done quite well because markets have done well. And it's created, and even clients that are invested in, a well-diversified, professionally managed portfolio doing extremely well. But what we sort of tend to see quite a bit, that I'm sure you see a lot, are clients that are also underserviced in other ways. And when you look at CEG Insights did a survey asking clients really across the industry, what type of services are you getting from your financial advisor? I think beyond investment management, and most folks are getting that, but it comes into the planning services that you offer when you're thinking about whether it's wealth transfer advice or tax planning. Do-it-yourself investors do not have tax management services, tax loss harvesting, et cetera, going on underneath the hood of their investment portfolios. Charitable giving and philanthropic planning, all of that type of estate planning, the majority of clients are just not getting it. So I think there's so many components that go into the services and that we provide our clients each and every day. And there's so much more to the picture of a client's financial health beyond, I bought a few of the stocks that happen to have been doing very well the last couple of years.
And where I think that stems from, Elizabeth, a lot of folks have created wealth that they didn't anticipate to create. So they don't know what they don't know, and they don't know what they're missing. And I say this all the time to my clients, is with success comes complications. And in many cases, we're walking them down different roads than what they thought they'd be going down, and introducing different concepts and strategies than they would have thought of on their own. But that's what I think makes us different in our region, is our financial planning services go beyond just money management. And that's the predominance of what we compete with here in our town. And again, that's what makes us different. Because a lot of those things, especially and these are people that have worked hard and not necessarily were always savvy investors, but because of their disciplines of savings and their investment solutions that they've chosen and working with firms like us have put them in a different perspective. So they're needing things they don't know they need, right? So
Absolutely.
But we recognize that, and that's why we partner with folks like you to not only just manage the money, but everything that goes with it, because it becomes all integrated at some point. And you need somebody to quarterback a lot of different complexities. We're doing that now with several of our clients, getting them in front of estate planning attorneys through different resources because of their success, right? And their complication. And they're having to do and think of things that they never had to do before. So it's been pretty fascinating. So with your team now, and I'm going to say this for the second half of the show, but let me just give you a primer. of what I want to talk about in the second half of the show is with client success. You kind of set the stage for me. I want to talk about how do we help them manage the tax challenges that many of our clients face because their value of their portfolios has grown so much that we really have to have a conversation about the tax implications on distributions. And again, we didn't have to have these conversations before, but now it's a significant amount, and it's an important conversation and things we need to tie up and how you guys are always paying attention to that. But before I veer too far off of that, so was there any other surprises in this quarter that you guys saw that was either positive or negative?
Right. I think, look, the geopolitical shocks, they're not new. We've seen that before. We can go back all the way decades in the past, and unfortunately, there are wars, there are conflicts, and I think we are seeing things move in a little bit of a better direction. Hopefully, nearing a formal sort of signing or agreement with this U.S.-Iran conflict. So we saw a bit more market volatility. We saw the price of oil obviously get to sort of a 2026 peak at the end of April. Now prices coming back down to maybe $80 a barrel, which is good to see because we know that elevated oil prices wears on the consumer, right? Not only has this sort of conflict in the Strait of Hormuz created higher energy prices. It's created higher inflation. It's created a strain on the consumer where we see the consumer sort of pulling back on spending. And like I mentioned earlier, we're seeing sort of government spending, business spending tick up, sort of make up for that for the whole GDP picture. But the consumer has stepped back, especially that lower end consumer, because we know the lower end consumer spends more of their overall income on gas. And so with that, also consumer sentiment is down. And so, we can handle the economy can handle higher oil prices for some amount of time, but for an extended period of time, that certainly does wear and would cause us to have more of a concern. So while we weren't necessarily expecting this going into the beginning of the year, we've sort of seen this story play out before, and the way that the market really is reacting to it as sort of a manageable event, and hopefully a short-term event. Markets have obviously recovered since then, but we continue to sort of watch some of these details very, very closely. Just as I mentioned, growth has been a little bit slower in this first quarter, and now we have inflation ticking up higher. So I don't know if it's a total, nothing new under the sun here, but those are just some of the headwinds that we're thinking about as well. And of course, we have a new Federal Reserve chairman taking his seat this week. And so, maybe coming in through the year, maybe through last year, some markets, some analysts thought we would receive more interest rate cuts. And with this inflation ticking up, it looks like the Fed will most likely pause on cuts, holding rates steady. There are, markets are certainly pricing in a little bit more of maybe even a rate hike through the end of next year or into 2027. And I think to your point, just around surprises would be anytime the market is pricing in one thing, anytime analysts' expectations say something else, and then what the Federal Reserve board members are saying in terms of what their expectations for interest rates. Anytime we have that divergence, we could see more shocks. We've seen interest rates sort of across the curve through 2026 move upwards. The 2-year in particular increased about 60 basis points from the start of the year. And so anytime we have this type of dynamic, luckily, as you know, we were starting from a higher interest rate environment. And we know that sort of inverse relationship between interest rates and bond prices. And it's great to clip a higher coupon, but if you own bonds already, those yields moving up on you is a little bit harder for your total return. But starting from a higher yield environment, you have a cushion, right? And we've seen that in our portfolios. On the Savo side, we've leaned shorter duration across our portfolios on the fixed income. through our core fixed income menu, that really helps us in this particular environment. So we have positive excess returns across our fixed income menu. That's been very additive for client portfolios. So nonetheless, I think as we move through the year, the growth inflation story will certainly keep a close finger on the pulse, as that really kind of tends to drive the dynamic that we're in for our equity and bond portfolios for clients, just continuing to position appropriately as the market dynamic changes.
Wow. Okay. Believe it or not, I got to take a quick break here. That's good stuff. And maybe we'll get more into that because the bond market is typically underloved and not talked about very much, but we'll be back after this break. Okay. I have Elizabeth McConville with me today. This is Leo DePrilly. This is the Gem Young Wealthcast. I'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
Hey there, this is Dan Rivers. Friends, if you're planning for a work optional lifestyle or looking for financial insight or just want real conversations that help you make smarter decisions, we've got you covered. Listen to the Gem Young Wealthcast anywhere you get your podcasts, including Apple Podcasts, Spotify, and the iHeart app. And now you can watch the full video podcast on their YouTube channel, Gem Young Wealthcast with Leo. New episodes every week featuring professionals, local leaders, and conversations that matter. Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo DePrilly.
Welcome back to the Gem Young Wealthcast. This is Leo DePrilly. If you're just joining the show today, this is our first installment of our quarterly analyst series, and I have Elizabeth McConville with me today. She's a senior regional investment specialist with AssetMark. Hey, Elizabeth, how are you?
Doing great. Great to be here. Thank you, Leo.
So before the break, there's two things. I know I gave you my 14 topics we're going to talk about next, but you brought up this is great investment strategy. So I just want to reaffirm what we talked about because the bond market with the volatile interest rates this year have not always been everybody's friends. They started out so. But with the interest rate volatility, even though we might be getting some more rate here or there, we're also giving back some principal. So the total return in the bond market's back to having headwinds again to a degree, right? It's not till we get to more of a stable interest rate environment where we can see bonds maybe having more. The income stream's always predictable. It's not about that. It's like you brought up the inverse relationship between what interest rates are and what the value of or the bond is, but it affects total return. And so there's two ways to look at it. Number one, especially if you're in an individual bond scenario, and you're looking for the income, then you only care so much because the underlying value doesn't matter to you because you bought them for the income. It's those that are maybe in a bond fund that seem to be challenged the most, right? Because they could still be getting the yield they want, but if they're looking at their total return, maybe that's a little bit weak, right? So one way is to hedge that, and I just want to reaffirm that. One of the ways to hedge that when we get into volatile markets like this is your firm's been doing a nice job with called short duration bonds. So that limits that principal risk, right? And while still trying to achieve yield. So you're giving up maybe a little bit of yield for more principal stability, right? Which adds to the total return of the portfolio overall. I think that's a key point. I just didn't want that to get lost.
Absolutely a great point. And owning a bond fund versus individual bonds, to your point, different story. And a lot of our investors are long-term investors. So they bought their bonds with nice coupons. They're getting consistent income over the quarters, and it's been a really good strategy for investors. And to your point, in particular with clients that need income are maybe drawing on some of these portfolios for income. And to your point, that shorter duration posture, even if interest rates are volatile across the curve, and even that shorter, it is more protective. And so we see clients do quite well the way that we positioned our bond portfolios, our individual bond portfolios and also mutual fund and ETF portfolios because of that posturing. And I think even at this particular point with yields where they are now, even if we see interest rates move up 1%, sort of that parallel shift in yield curve across the board, something like a 2-year US Treasury and below, even the 5-year, kind of that shorter to intermediate part of the yield curve, because of those higher interest rates, should still have positive returns, given even a 1% rise in interest rates for here, because we're starting from that higher interest rate level. And, without those short term, those are US Treasuries, high quality, backed by the full faith and credit of the US government. So not really worried about the credit risk from that perspective. So it's been a good thing for clients overall. So thanks for mentioning that.
So one other question I just thought of, with the improving financials of many companies, and there used to be a bigger spread between the high yields and maybe the higher quality corporates. Are you seeing rate compression in that market, in that space?
Yeah, to your point, spreads have been pretty tight when we're thinking about investment grade bonds and high yield. Typically with high yield, how much more are you getting paid to own high yield bonds versus US Treasury or investment grade of the same duration profile. High yield has still continued to do well, yields in the 6-7%. High yield strategies have continued, but to your point, are you really getting paid that much more, given the risk that you're taking on, and given just where equities become more volatile, high yield can become more volatile too. So where high yield has performed very well, to your point, spreads are they're very tight. And there's a lot of places in fixed income to go that are, decent yields across the belly of the curve in investment grade and also US Treasury. So fixed income still, we've had correlation issues with bonds starting to move like with equities over the years. And so just diversification and diversifying your diversifiers. So when we're thinking about fixed income, for especially our higher income earners or clients living in high state tax, those munis, another way to diversify. So, diversify your diversifiers and being able to move across the fixed income sectors has been additive, and using, appropriate amount of alternatives for those appropriate clients as well.
Right. So that I'm glad you brought that up, because the fixed income space has become highly complicated. It's not just a traditional bond buy or sell like it used to be. There's a lot more that goes with it. And that's where having the information that you folks have and the way you approach it builds a different portfolio than most people typically think about, right? So let me go here now. This is the dilemma. It's the dilemma of success, right? With a lot of our clients, we've had incredible investment performance success, which, as you know, as a financial planning firm, our hallmark is helping folks aspire to and keep a work optional lifestyle, and to help them to live the life they choose on their terms. So we've been effective at doing that. And as you know, Elizabeth, we build our financial plans and we build them to a goal rate of return. And although we benchmark our managers against indices and their peer groups, we don't have those conversations with our clients. We have conversations about how did the investments perform in relation to the goal we needed in the plan for you to be successful. So in many cases, we're far out exceeding that. So our clients, we're having different conversations today about larger distributions, leaving legacies. So these are conversations with folks that never thought they'd have these conversations. But one of the challenges is there's so much built up capital gains within these portfolios, we're having to manage the tax situation differently. We're starting to have more of those conversations. And there's a service, one of the services you guys provide that helps manage the portfolio. So I want to I know we talked about it a little bit last time, but I think it's becoming super relevant, especially after 3 years of things being hot, why this matters, the tax management service. So
Absolutely. It's such a good point. Over the years, these last few years, these double-digit returns and strong returns, strong portfolio returns, it's all a good thing until you're ready to do a distribution, or maybe it's time to rebalance the portfolio. Maybe your working years, your accumulating years are now over, and maybe now you're starting to draw income, or maybe your plan, maybe you're moving into a different life phase, and now we're shifting into a bit more of a preservation style portfolio. There's lots of reasons where you might need to either adjust your portfolio or shore up cash, take income, etc. So strong portfolio performance is a great thing. But when it comes to taking a distribution, everyone's least favorite thing is taxes. And many do-it-yourself investors, maybe a lot of clients in professionally managed portfolios, don't have the tax management services that we have. And it's a absolute game changer, because it's not just about what you keep. It's about not just about what you make, it's about what you keep. And the tax management services is firing on all cylinders. So each and every day, looking across all of the holdings in a portfolio for a taxable account, looking for a position that has fallen by 5% and $50. So we just want that position to be large enough. So 5% and $50. Actually, 75% of the stocks over the last couple of decades in the S&P actually do fall by 5% each and every year. It's just a little bit of volatility is normal in markets. It's normal within each and every company name. And so we take advantage of that volatility through tax loss harvesting. We can harvest that single position loss and replace with a like ETF or a like stock to maintain that particular market exposure, whether it's a tech name, whether it's a healthcare name, and wait the 31-day wash sale rule so that IRS can actually honor harvesting that loss. And the portfolio continues. And so what we see, especially with our individual stock portfolios, is very strong tax alpha because we have many individual positions. If you imagine different equity style sleeves layered together, a core, large cap core strategy paired with an international strategy, paired with a small and mid cap strategy, maybe a tactical equity strategy, we can get 150 individual stock names in a portfolio where we have a lot of different positions that we could harvest each and every day. And that's the neat thing about it. It's not just at the end of the year. Many advisors offer tax loss harvesting maybe on a quarterly basis or at year end. That's not how markets work. We don't know when the volatility is coming. So this is algorithmic. It's each and every day. It's intraday. And that's the really special thing about it, is we can get a lot of meat off of the bones where the portfolio over the course of the year can be up while we've taken advantage of those momentary losses. And that's what makes it a lot easier to be able to take these distributions without the tax pain, or be able to make a rebalance or move from one portfolio to the next portfolio when needed, and be able to do a tax transition. If you've been doing it yourself, if you're worried about those gains, you don't want to touch it, there's a way to transition to your portfolio, to your financial professional like Leo, without that tax pain. And so it just gives a lot more power back to our advisors, back to our clients, to sort of customize a tax plan that works for them.
So I'll preface my next comments with my chief compliance hat on by saying past performance is no guarantee of future results. But you set a term in there that most people probably don't understand, and we should explain its significance, and that's tax alpha. Because the challenge many people have when it comes to managing the gains in their portfolio is FOMO. They're afraid they're going to miss out if they sell something, right? And there's an opportunity lost. But tax alpha means, did it provide excess return over the portfolio had you not done it, right? Or negative if it worked against you, right? And that's important for people to understand, that tax alpha means because of this, your investment performance actually improves while increasing your cost basis underneath. So, and this is not something you wait to when you need money, because if you wait till you need money, it's kind of too late. The gains are built. They're embedded. They haven't been managed for years. And we're seeing this more with our clients, Elizabeth, by saying, look, if you don't need the money for 5 years out, good. We need time to get to work on this. We need time to increase your cost basis by putting this tax management service in. So when you do need the money, it's not going to be a significant tax implication for when you do. So I think that's key too. So, and the other thing too is when we're onboarding new clients and we're bringing on those accounts. In the old days, it would be, okay, we'll do a tax workout over 3 years, okay? And we'll just tranche it into thirds, a third, and a third, just kind of minimize the bleeding, if you will. Unless there was a significant market correction that allowed us to, because I like to say to clients, sometimes you sell high and buy high, sometimes you sell low and buy low. And that's how you have to look at tax management strategies sometimes, right? But this program that you guys embed, and it's important to note that Savos is a manager in the AssetMark platform, and it's one of the managers we choose because you guys are so darn good at what you do that this service, if you're a Savos client, you're not paying any more for this either, right?
Absolutely. And when you look at the savings and the point about the tax alpha, the point about the tax savings, the neat thing is clients that are enrolled in the service, and for some of the strategies at AssetMark, it's actually free and included. And otherwise, the cost is so minimal compared to the savings. And the great thing about the savings is that each account that is enrolled gets a savings report. So you can actually see that tax savings on a monthly basis, a quarterly basis, and an annual basis, the lifetime of the account and its enrollment. And that's really, really neat because no one likes to get hit with that 1099 or that unexpected cap gain at the end of the year, especially when, hey, I didn't take a withdrawal. I didn't personally sell anything. Maybe Leo did it. No one did. So why am I getting hit with that? Because there's active management and those mutual funds, it's a great vehicle for, lower minimum dollar amounts, but a lot of these sort of growth portfolios, mutual funds, you are hit with the cap gain regardless of what you do. Sometimes even the portfolio could have been down for the year and there's still capital gains. This is a very, very sophisticated program, and we're really very, very lucky to have it on the platform. So the great thing is, average accounts, we've looked at the entire AssetMark platform over the last couple of years, whether it's more of a equity-based portfolio, fixed income balanced portfolio, and the tax alpha in 2025, or that tax savings, was actually 1.29% of tax savings on average across portfolios, and then 1.43% of tax savings in through 2024 and then 2025 respectively, those numbers. So it's nice to be able to actually have data and have real numbers to show just the power of this. And that might not sound like a big number, right? But if you imagine 1% tax savings plus each and every year over the course of a 5-year, a 10-year, and the compounding of those numbers, the savings gets very, very big, very, very quick. That is meaningful savings over the course of a market cycle.
I think it's significant because if you don't do it, excuse me, it looks like little bits till you say, hey, Leo, I need $25,000 to do whatever. And we say, okay, well, we got to start making some trades to do it. And if you're in a situation, which many of our clients are, where there's significant capital gain. So that's why we've been doing this work for a couple of years. I just want to bring people up because, again, with your success comes complications, right? So we're almost out of time. Got a few minutes left. I'd like to hear where you and your team think the rest of the year is going to finish.
Yeah, it's a great question. Like I said, the Fed is meeting today. I think the course of inflation and growth, absolutely top of mind. So I think as it comes to inflation, just keeping a finger on the pulse. And I think what the Fed's meeting will do and whether they hold, and that's what analysts think will happen today and tomorrow at these meetings. But nonetheless, it's really the tone of the Fed coming out of this meeting. When we look at sort of the forward, like the 12-month forward US Treasury yield curve, that curve does look a bit higher than it does now, not drastically higher, but a bit higher. And like I said, starting from a little bit of a more elevated interest rate environment that we did the past years where we had interest rates at zero. Obviously, when interest rates are held at zero and we get a 1% increase in rates, that hurts. But we're starting with some yield. So I think all eyes will be on the Fed and probably more importantly, the Fed's tone. If they think we are, inflation is meaningfully above expectations or where inflation should be. And I think that will kind of set the tone for what we can expect with interest rates through 2026. I think keeping a finger on the pulse just in terms of growth. And if growth can continue, and even if it is slower, even if it's a little bit more sluggish growth, but stable enough to propel our economy forward. And certainly the way that we watch AI spending. And like we said, those winners and losers, and in the Savos portfolios leaning into that factor screening. So if we have disruptions, like really focusing on those companies with the strong momentum. And when that momentum changes, we always get this question, Leo, and I'm sure you do too, with markets at all-time highs, how are we thinking about portfolio construction? How are we thinking about money management? And that's exactly what we do each and every day. We have, portfolios where we're direct indexing and we're just tracking these indices. We also have portfolios where we're using that active management to take active overweights and underweights in particular names, in particular sectors to express what we're seeing underneath the hood with company earnings, with their income statements, their balance sheets, looking at those cash flows. We've got strategies where we're looking for yield, we're looking for dividend yield. Are these companies holding back enough money? Are they reaching to pay out their dividend yield, or do they have healthy dividend payout ratios? And leverage, especially with this AI infrastructure build, leverage is important as well. Is the leverage ratio appropriate for the company's capital structure? So these are all things that we're looking at to find the health of the companies and where do we really want to lean in and what companies might we want to lean out. And as much as we like to look for strong momentum, after a company has had a great run and maybe those quality metrics underneath the hood aren't looking so good and we see momentum change in the other direction, that is a really great time because we want to let the winners ride and we don't want to follow the losers all the way down. So those are sort of those factors, that factor screening in the Savos portfolio that we put forth. So as we look forward, not really reinventing the wheel, but just using that time-tested process and using volatility as a friend, right? For the tax loss harvesting opportunities. Liberation Day with geopolitical risks, all accounts across the company platform are experiencing tax loss harvesting. And just wrapping all of that into an easy package for your clients.
Awesome. Elizabeth, thank you very much. I am out of time. You did awesome, as you always do. So I had today a Senior Regional Investment Specialist, Elizabeth McConville from AssetMark. Elizabeth, thank you very much. Have a great day.
Leo, thank you.
Take care.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or Supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare Supplement insurance plans. This is an advertisement for insurance.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo DePrilly.
Welcome back to the Gem Young Wealthcast. This is Leo DePrilly. Well, that was another great show with Elizabeth. I know you'd find her insightful. She's got a lot of information, and the management team at Savos are crazy smart people. That's why we use them for our clients. But, you know, we just not only got a market recap, but we really got under the hood of how things happen so that you can understand the depths of what we do for you. So it was a great show today. I appreciate having Elizabeth on. And just check out this podcast anywhere you get your podcast. This is Leo DePrilly. This is the Gem Young Wealthcast. Until next time.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
Hey there, this is Dan Rivers. Friends, if you're planning for a work-optional lifestyle or looking for financial insight or just want real conversations that help you make smarter decisions, we've got you covered. Listen to the Gem Young Wealthcast anywhere you get your podcasts, including Apple Podcasts, Spotify, and the iHeart app. And now you can watch the full video podcast on their YouTube channel. Gem Young Wealthcast with Leo. New episodes every week featuring professionals, local leaders, and conversations that matter.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo DePrilly.